It all starts with a problem. You notice that something is broken. It's painfully obvious, yet it still exists. No one's doing anything about it. Why is no one doing anything about it? Maybe they haven't noticed. Maybe they're just too busy, but you're gonna fix it. The problem is your opportunity. Can you do it? Maybe. You reach out to some people who have the problem, and you don't hear back. You reach out to some more, and they reply, "This is great." Wrong. They don't care about the problem. You reach out to someone else, and they're excited. Finally. They introduce you to some friends who care too. You listen to them all. How do they describe the problem? Are there patterns? Yes. It's time to get to work. But wait, you need some help. You don't know how to do everything. You tell a friend about the problem and your plan to solve it, and they want to help, but they have a job already. They can't work for free, but how can you pay them if no one's paying you to solve the problem yet? So instead of cash, you offer them ownership of the company you're going to form to solve the problem. And since nothing's built yet, you're both taking the same risk. You offer them half the company if they'll quit their job and go all in on it with you. But first you make sure that they really care enough about the problem. You talk about how solving it will need sleepless nights, personal sacrifices, and some good luck too. You're honest. It might not work. In fact, it'll probably result in nothing at all, but it might change the world. And it might be incredibly valuable to own part of it. They're in. You're gonna solve this together as co-founders. You talk about who should have which job. There really should only be one CEO. You pay $500 to set up the company on Stripe Atlas. You choose a Delaware C Corp structure since you plan on raising some money later. In exchange, the company will now have 10 million shares. You each keep 4.5 million and will own 45% of the company. You agree that you'll only earn or vest those shares over 4 years with a 1-year cliff before you earn any at all. This way, everyone stays incentivized to earn more by working. The last 10% gets saved for future employees. And a few days later, the government tells you that your company now exists. You connect your Stripe account to your new Mercury bank account so you can start accepting money. But first, each of you puts some of your own money in the bank and sets aside $30 each in exchange for your 4.5 million shares. You make sure to do this within the first 30 days to avoid any tax penalties down the road. This means the value of each share is tiny, but that's okay. You know you can make it worth more by solving the problem. A few months have passed. So much is different already. You were right about the sleepless nights. And everything takes longer than you think, even when you plan for it to take longer than you think. It turns out you and your co-founder don't always agree on everything, but you're in this together. And those people you spoke to are now using a simple version of your solution. So are others. You're even making a little bit of money, but you heard about someone else trying to solve the same problem. You keep an eye on them, but you don't obsess. You obsess over your users. Either way, it's time to move faster. You ask your users for testimonials and put them on your website. You start talking about how things are going on X and LinkedIn. More users sign up, but the money you're making just won't cut it. Your account says $423. The credit card is over $5,000. Rent's due in 2 weeks. You need more money. A lot more, and fast. You need investors. Time for a pitch deck. But where do you start? How do you tell the story? How do you attract investments? You find the Sequoia Capital pitch deck template. You add every detail. Wait, no. You keep it light. No wall of text. You're telling a story. The deck is just a sales document. You'll go deeper on the investor calls. But how can you get those? You don't even know any investors. You find the Founding Journey investor database, info on thousands of investors. You DM and cold email a ton with your deck. You eagerly await their replies. Surely they'd be interested. You're changing the world, and your deck is good. You ask a founder who recently announced their fundraise, how do you get investors? They got an intro from another founder that investor had previously backed. You ask them if they do the same favor for you. You tell them your story and share the deck. They say no, sorry, oof. But now you know. You go on Crunchbase. There's a list of every startup every investor has funded. You find the founders on X and LinkedIn. You have mutual connections with a couple. It's time to send some DMs. Eventually, someone says yes. They saw your posts about your startup from before. They think it sounds pretty cool. They intro you to a few investors. You share the deck and your Calendly. Some investors book calls. They trust your new founder friend. It's go time. On the first call, you run through the deck for 30 minutes. The investor looks bored almost right away. Are they even paying attention? They email you right afterwards. They're not interested. That was weird. But wait, the investor had already seen the deck before the call. Did they really need you to present it to them? Maybe they had questions they wanted to ask. Let's try this again. On your next investor call, you intro yourself and then ask the investor what questions they had from the deck. They ask about the business, but they seem a lot more interested in getting to know you and your co-founder. They want to know if you're capable of greatness, if you're dedicated, how fast the market is growing, how fast you're learning from users, and how big can this business be? The investor seems engaged. After the call, you feel really good, and you repeat this with a few others. A week later, a couple have said that they're in. You send them safes, simple agreements for future equity. It's a promise. You're saying that in the future, when you raise more money above a certain threshold or cap, this investor will get their shares at that cap. Maybe the lead investor writing the biggest check says what valuation cap they're comfortable with. But maybe you're able to influence it. You set a target cap based on how much money you're raising in total and knowing you only want to sell 20% of the company. Either way, a safe is great for you. You avoid big legal costs for now. You tell the other investors that the round is filling up and momentum builds. And in the end, you're oversubscribed. You have more money on the table than you planned to raise. It's negotiation time. Now, there are two types of valuations. Pre-money valuation is how much your company is worth before the investment. Post-money valuation is the pre-money plus the investment amount. Investors want a lower post-money valuation to maximize their returns, but you want it higher to retain more equity. In the end, you're able to bump the valuation cap up an extra $1 million, but you're still only selling 20% of the company. Once the deal is done, you and your co-founder will be diluted. You'll issue 2.5 million new shares to the investors. That means 12.5 million shares now exist in total, and you own 4.5 million. So instead of owning 45% of the company, you now own 36%. But since each share is now more valuable, you're happy. And you chose investors who believe in your vision and have good industry connections. Congratulations, you just closed your pre-seed round, but you want to get back to building the business. 2 years have passed. Everything is different. You're doing your best just to keep up. You've hired a team and you raised more money on a safe with a higher cap, your seed round. Many new users are signing up every day. You answer support tickets in your dreams. It's hard to consistently find time for anything but work, but investors are DMing you on social media now. They want in. You're burning money every month to help accelerate growth, and you've got about 12 months of cash left in the bank. So it's time for your Series A. This round is different. You'll need to formalize your valuation. Those past investors who bet on you early with a safe will now have their investments become real equity too. And if you pull it off, your startup is on track to become a unicorn and reach an exit. But the investors will want to see a few things first. You'll need to show them that you have a repeatable and scalable way to acquire new users, and the users stick around, and that there are enough of them in total, and that you're making enough from each of them for the business to be sustainable. You meet with some of the most well-known VCs, and one of them agrees to lead your round. Smaller investors fall in line and the round comes together. You announce it and things feel different. Users, partners, potential employees, and the press all take you much more seriously now. You actually are changing the world. You go on to raise a Series B, C, and D in the next few years. Each time you get diluted further, but the company is worth a lot more. It's over $1 billion now. And your 4.5 million shares are still a meaningful part of that, even if they only make up a smaller percentage of the total shares. And actually, you've sold some shares along the way. It's called a secondary. Sometimes investors buying into the company buy a few of the founder's shares as well, and the founder pockets the cash. More importantly though, your users love your product. You're doing over $100 million in revenue per year, and everyone in your sector has heard of you, but you still keep growing. Your investors keep mentioning it's time for an exit. The value of everyone's shares is way up, and they want a return for the risk they took investing in you early. They want to use that cash to invest in other, smaller startups again. And since you're diluted, you can't just shut them down. It's a collaborative decision. You have two options, acquisition or IPO. If a big company acquires you, maybe they pay you some cash for your shares, or maybe they convert your shares into shares of their company, and you'll need to work there for a while in order to get them. And that just sounds like a job. Thankfully, you're growing fast enough where the public might be interested in buying shares of your company. So you decide to do an initial public offering, or IPO. On IPO day, your company issues new shares that the public can buy and sell freely. It's the first time the public has been able to own part of your startup. Your old investors mostly cash out right away, but you and your team can't. Your shares are locked for 6 months, This is so the public doesn't lose faith in the stock. But either way, your personal net worth is now in the hundreds of millions, maybe even the billions. And after 6 months, you sell some of your shares, but don't want to cash out too much. You're comfortable from your secondaries along the way, but more importantly, you know that the company can still grow a lot more. The investors might have called it an exit, but for you, you know it's still just the beginning.